Imagine you walk into a car dealership. A classical car is selling for $50,000. You believe in 2 years, collectors will be willing to pay $80,000 for the same car. So you buy it today. Why? Because you expect its value to rise. If you are right, you can sell it later for a profit. The same idea applies to derivatives. When you take a long position, you are betting that the price of the underlying asset will increase. You expect the asset to be worth more in the future than it is today. Imagine you enter a forward contract to buy 1,000 shares of Apple at $200 per share 6 months from now. 6 months later, Apple is trading at $240. Even though everyone else has to pay $240, you still have the right to buy at $200. Your expectation was correct. The increase in Apple's share price works in your favor. Taking a long position doesn't necessarily mean you already own the asset. It simply means you have entered a contract because you expect the asset's value to rise. If the price goes up, you benefit. If the price falls, you lose. That's the essence of being long.